prices are dropping. We're down almost 9% on West Texas Intermediate in just 1 week. But are the bulls? They're not crying. They actually think things might still be moving higher as we go into the fourth quarter. But we brought in our buy, hold, sell expert. Well, welcome everyone to the program. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host Tobin Smith out in sunny and somewhat cooler Scottsdale, Arizona.
Thank you, Todd. Finally.
And we are bringing back a very audience fan, our friend, and we're a big fan of Fernando Valle. He is the senior oil and gas analyst at Bloomberg Intelligence. He's actually reporting today directly from the Bloomberg mothership at 731 Lexington Avenue in Midtown Manhattan, which is always really cool as far as I'm concerned. But Fernando, welcome back to the program.
Good to be here, Todd.
Thank you. Well, we have we've oil today. What a day to have you on, because we are seeing oil prices just get bombarded. We are down 5%. We're down almost 9% in 1 week on West Texas Intermediate. Why the sell-off?
Well, I think that's actually been my base case all along. And if you remember the last time I was here, I was fairly bearish for the long term. And because we don't think OPEC can fight the Fed. And ultimately, that's what they're trying to do. And everyone who has tried will be unsuccessful. So there were two aspects to it. First, the demand destruction was already happening, very evident on the gasoline side. But then probably the bigger movement in oil prices has been China. China saying they won't issue new import quotas for oil, China being the largest importer of oil in the world. That is probably going to lead to higher competition in that market. And you're seeing that because the differential between Brent and WTI has collapsed to under $2 a barrel.
Yeah, I was going to ask you, I haven't seen that. I can't remember the last time I saw Brent and WTI go that south. Hey, Fernando, so I was just telling you beforehand that, man, I'm in California, up in Malibu, with a lot of rich people. And they're bitching and moaning about, the gasoline prices, $6.78 when I was there. I, of course, rented an EV, by the way. It was awesome. The demand destruction, do you have sort of a dollar point of where is there a correlation between, is there more demand destruction at $6.50 a gallon or $6 or $5 a gallon?
Well, I think that's specific to California. Those prices tend to be significantly higher. You saw, for example, when we went above $3.30, $3.40 a gallon on a national average, which happened just at the end of June and July, as Brent and WTI rallied, and also the crack spreads the margin refiners make also widened. That you already saw a leg down on the on gasoline demand. So July is supposed to be a very strong month for gasoline demand, and it already took a significant leg down. I think the bigger problem is not just fuel itself, but it's everything else that's happening in the background, from the resumption of student loan repayments, higher mortgage, Medicare, the subsidies ending from at the end of the healthcare emergency. All that is impacting disposable income, and ultimately that's what governs gasoline demand.
Wow, you're a macro guy now, Fernando.
I always was. If you cover oil, you're always a macro guy.
Yeah, you have to be, right? Well, yeah, quick question for you, though. That's on the domestic side, the concerns you brought up. So let's start talking about the oil cuts from Russia and Saudi Arabia. What kind of an impact? Because if that's the case and we're seeing a cut in supply, why are prices dropping?
Well, 2 points there. First is Russia didn't really cut that much. But more importantly, one of the big bull arguments early on was we didn't have spare capacity for oil. And when OPEC cuts, what do they make? Spare capacity. So the big issue is not really the supply. It's really the demand side. That's what the tape's telling you, is that demand is weaker than expected. You can see it, for example, in the Japanese currency. You can see it with China blocking the oil imports and in their quotas. And then in Russia, you mentioned their cuts. They actually have an issue now because they've forbidden exports of fuel. Russia, because it's primarily an export nation, doesn't have a lot of storage. So they won't be able to continue storing products for a much longer time, which means either they're going to have to export crude or they're going to have to lift those sanctions. So,
Fernando, Russia obviously has been selling, their crappy oil, at the $60 rate to China and to India. And in my math, that's been saying, well, okay, then that's cutting demand for, U.S. exports, particularly to India and China. Is that correlated?
It definitely is, but I think it also opened the market for Europe to U.S. exports. And I think that's partially why we've seen that compression in Brent WTI, because as opposed to having to discount it to compete in the Asian market, we're now only having to go to Europe, where we have a lot less competition and the freight significantly cheaper. Then on top of that, OPEC cutting their supply, showing that there is weak demand. That's essentially the suppliers competing more and more for the consumer of oil, the ultimate consumer of oil.
Yeah, and how did one of the comments, I'm just going to say that, comments that I hear a lot is about, okay, the Strategic Petroleum Reserve now is down to like a 40-year low, and if it goes any lower, that all of a sudden the caverns are going to collapse, yada, yada, yada. Now that we're not pulling out oil, and by the way, you know this better than anybody, guess who bought all of our Strategic Petroleum Reserve, Todd? China. If you look at the actual sales, I mean, it was just crazy. But does that factor in that it's too expensive now for us to essentially refill the SPR at current prices?
No, I think that's not the big driver. It was an anticipation of planned sales from the SPR. So we don't really we're not required by law to refill it. And I think we'll have the opportunity to refill it at much cheaper prices down the road. That's my view on oil prices. But what's important also is that when George Bush raised the SPR after the September 11 attacks, we produced 5.5 million barrels a day.
Yeah.
We produce 13 million barrels a day now. So we have a lot more flexibility of having a lower SPR. The security risk is not as much, because between the U.S. production of 13 million barrels a day, a little over that, and then over 4.3 million barrels a day from Canada, we have a lot of the supply in North America locked up that we need in case of emergency.
And the other narrative has been the conversion of the drill baby companies, the frackers, to cash flow baby frackers. And that was one of the arguments of why oil was going to remain higher for longer, is that the depletion rate on these fracking wells, or fracked wells, I should say, particularly in the Permian, is pretty rapid. And they're not replacing that. Doesn't that put somewhat of a floor? Or tell us how low oil goes. I just made that up right there.
Well, so I think, again, the short term is really demand driven. And our view is that it's already being affected. And because the consumer can't withstand more of this.
At the margin.
Yeah, at the margin. And again, that's punctuated by today's EIA numbers on the demand side, the lowest in 10 years. On gasoline.
Wow.
But then as you go, for seasonally adjusted, but then as you go in the longer term, beyond 2024, or maybe even the second half of 2024, what you're bringing up, Tobin, is totally true. A shale well will decline 90% within its first year. We haven't really invested in exploration outside of U.S. shale over the past decade almost. So we don't have the supply to make that up. And everyone expecting that OPEC can just bring on more and more capacity, that's, to me, very wide of the mark. They have exhausted their ability to grow, not to produce, but to grow.
Mm-hmm.
So they'll have some because they've created this spare capacity now, but beyond that, they don't really have the ability to grow. So we'll have to rely on my native Brazil, Guyana, and potentially more exploration to bring that back. The issue is, at 8% interest rates globally, it's not just the cost to drill, it's also the cost, because it takes you 3 months from spud to production at least, if not longer. So a private operator is no longer making the returns that they were at $60 oil, even like a few years ago, because rates are so much higher.
So here's a silly question. Is the SPR empty?
No. Still fairly significant. It's just that it's lowest levels in about 10 years.
Well, okay, lowest level in 10 years. And from a national security standpoint, that seems quite frightening to me, because it's always nice to know that we have this, and because Americans need oil. But with that, you said that we are pumping. You said what was it? 10 million barrel.
13.
What is it?
13.
13.2.
Okay. So how much oil? Because what was it, like 10, 15 years ago? I think worldwide we were consuming 85, 86 million barrels a day. What are those numbers right now as far as what's being pulled out of the ground and what humans are using worldwide?
So the total demand is around 102 million barrels of oil and condensate. And then in the
Per
US
day.
per day.
Yeah.
We produce just north of 13 million barrels a day. Canada produces around 4.3. The US refines just shy of 18 million barrels a day. Canada is just about 1.5. So, and we consume in the US about 20 million barrels a day. In Canada, about
barrels. 1. So 102 million worldwide. How many barrels of oil are coming out of the earth each day?
Just about the same. We're close in balance. There is obviously periods of inventory build. They tend to be seasonal, but you typically try to match the balance.
So there's not a lot of margin there. I mean, it's one thing if you have something that happens, it could be detrimental and obviously push prices a lot higher.
He's not a mind reader, Todd. He's an analyst, okay? He doesn't know if Putin's going to go crazy. My question, Fernando,
he's a brilliant analyst, and
yeah,
and he's been spot on every time we have him on the show.
Very true. So, Fernando, do you do any work on product tankers or on just oil tanking, etc.?
I tangentially. So it's not my area of expertise, but I obviously know the cost to ship product and crude into key destinations.
Yeah, I've been, we've been very long LPG. It's not quite your bailiwick, but simply because the demand has been so strong from India and China and so on and so forth. But in the part of the world where we're shipping oil and then it's getting refined, is Europe having the same sort of slowdown on demand as we've seen here recently?
Certainly on the gasoline side, but there is a huge concern on our end for diesel and middle distillates, because what Russian crude does is that it produces a fair amount of that, and our crude produces a lot more gasoline. And that's so with both Europe and the US running what we call a lighter crude slate, more light oil like shale, we tend to produce less diesel. And what is diesel good for, if not some of those tankers you talked about, transportation, but also heating and as a backup for power generation. So when you look in the East Coast, for example, we're at the lowest levels in 10, 15 years on diesel. Europe is also at very low levels. So it creates a big concern. And that's the real security risk from my standpoint, that if we have a cold winter, prices can spike significantly and to become unaffordable for consumers that will need it for power generation and heating.
Yeah, particularly in the Northeast. So do you do natural gas, my friend? Is that also on your plate?
Not directly, but again, I look at all the major oil companies, and they're big natural gas producers. So
yeah, well, I'm interested in this weather pattern. The El Nino winter, from all the data that I get, says that we're going to have a cold winter, and that typically means higher natural gas prices. Am I smoking the wrong pot, or am I close?
Well, if you think about last year, we had the warmest winter in 50, 60 years in the Northern Hemisphere, and they're usually followed closely by the coldest. So we don't go from, it progressively goes from warmest to cold. And so I'm with you. It's hard to predict, but I agree with you. And, I was just speaking to a colleague and saying, everyone's very complacent because the European natural gas inventories are near the brim, but they aren't season-long inventories. They can be drained very quickly if there is inclement weather. And we have to remember this is going to be the first real winter where Belgium has shut all their nuclear reactors. Germany has shut all their nuclear reactors. Holland has shut the Groningen field. And even here in New York, we shut all our 3 nuclear plants in 2021. And Boston.
Now, those are for repairs, right? They're not doing it permanently.
No, they've closed them.
Really?
Yeah. And Boston relied on natural gas that was imported or re-imported from Russia. So it becomes very tenuous, especially in New England, because as you said, New England still uses a lot of diesel for heating.
Wow. I must have been gone one day. I did not realize that they actually, and they're not doing anything to reopen them?
No, Indian Point's closed. It's by my house and totally closed, mothballed.
Wow.
That's
Hey,
amazing.
so then the next question is, in Brazil and Ecuador, the most screwed up country I've seen recently, these new salt dome, offshore wells are just starting really to crank it up. How much more can they produce? Since sounds like they're the marginal player here.
Brazil still has a significant potential. Guyana is more than doubling in the next 5 to 7 years. Exxon is the largest developer out in Guyana. But we're speaking, Brazil produces just shy of 3.5 million barrels of crude oil, so it's a fraction of the U.S.
Yeah.
It can maybe get to 4 million over the next 5 to 10 years. There's a host of other challenges in Brazil, from political to even just exploratory exploration market, and then the development market. And then Guyana, it's going from about just under 1 million barrels a day to probably around 2.5 to 3 million barrels by 2027. That's all really driven by Exxon and Hess. Total's also there, but most of it is going to be driven by Exxon and Hess. And so I think it's significant, but it's not the solution to, we thought the US was going to get to 18, 19 million barrels a day. That's a 6 million barrels a day delta that we need to make up. And Brazil and Guyana are maybe going to be 1 to 1.5 of that.
So 18 million a day from the US would then balance the market, or that's what the demand is going to be?
Well, remember, the rest of the world is on permanent decline, right? Everything in oil declines at anywhere between 3 to 7%, depending on the oil price. Mm-hmm. So you have to make up for that decline and then meet the growth in demand. So that's 3 to 7 million barrels a day of decline that you have to make up every single year. So if we went from 13 to 18 million barrels by 2027 in the US, that's 2 years that you've made up.
Yeah, that's a good point.
It's not enough.
Yeah. Wow, I think I should then start going along airlines here, because their prices, if you're right, are going to be coming down, and they just got crushed, over the summer with the high prices.
Well, but remember, in this case, it's a demand-driven issue. So I started my career working for airlines. So this is not the ideal scenario, and especially if what happens to oil, in my head, works out after we have this initial crash.
So then you're saying that the macro, if the price of oil is coming down because demand's coming down because macro environment is getting the marginal buyers out of the marketplace, then that's not good for jet travel. Okay.
It would just be your friends traveling from Malibu.
They're on private jets there, Fernando.
Exactly.
So
yeah, XO, baby. I love it. XO. I'm going to do an ad for them.
Final question before we close this out. So any predictions for the fourth quarter as far as oil prices with West Texas Intermediate, maybe even gas prices? I mean, obviously they go hand in hand, but what are you forecasting, Fernando?
So we're expecting the average U.S. retail price to go from around $3.80 now, just to around anywhere between $3 to $3.30 per gallon. So good news for consumers on that end.
Wow.
Just because of the latest shift. Again, the gasoline crack spread went from $38 about a month and a half ago to 10. So that's a huge drop. And so then,
that's not good. That's not good for refiners' margins.
No, although diesel continues to be very strong. So some refiners benefit still very, very much from this.
Which ones?
Valero does pretty well. Marathon does pretty well with their diesel component. And then I think that, the East Coast refiners, they have a locational advantage right now because of how the demand is skewed, like PBF and Phillips 66's Bayway refinery. And then
Does
on
Valero
the
still have the refinery in Delaware?
yep, that's Delaware City.
Delaware City, that's right.
Yep.
Yeah. Okay.
And then as far as crude, I think ultimately it's a macro game. I'm watching Japan very closely, and I'm obviously watching the Fed meetings. My view is that we end lower, below 80 on WTI. My colleagues that cover Brent think we're going north of 90 again. My because of the supply side of the equation, my feeling is still that the demand outweighs supply, especially in this near term.
Okay. I like that.
All right. So
well,
we're going to 80. Is that what you're saying, Fernando? I just want to double check.
80, yep.
Sub 80. Okay.
okay. Hey, that's a great, those are some great numbers. I know the audience is going to love that. Well, Fernando, we thank you so much for joining us. We know that you're in high demand there at Bloomberg. Everybody probably wants to talk to you.
Bloomberg Intelligence, Todd. Bloomberg Intelligence.
Bloomberg Intelligence. Well, I'm thinking of the news, the television and radio side of Bloomberg LP. But that's a topic for another time. So listen, Fernando, thanks again for joining us. So on behalf of Fernando Valle, who is the senior oil and gas analyst at Bloomberg Intelligence, and Tobin Smith, I am Todd Schoenberger. Thank you so much for joining us today on Buy, Hold, Sell. Take care now. Thank you.
Buy, Hold, Sell, brought to you by CrossCheck Management.